Hey traders, Jason here from Levitt Brothers. So let's take a look at the current state of the market. We'll look at the indexes, we'll look at some breath readings, try and get an idea of what's going on. The indexes have been heading straight south for over a month. A lot of damage has been done both to the charts and psychologically in the country. I think this is probably the worst drop we've had since the 2022 bear market, even worse than a little bit of a pullback we got in 2023. It's different. The points lost, the force to the downside, the psychological damage in the country. This is a little bit different than a normal rank and file pullback within an uptrend. To me, the uptrend is over. It's just a question of whether we base here for a while and then move back up, or if we bounce and then we have to head south again and really wash people out. Right now, the S&P is down about 10%. Is this it, or are we going to go down 20%? We don't know. But in the here and now, near term, let's check out what the current situation is. All right, so here's the S&P 500 weekly. Okay, as you can see, 4 consecutive down weeks. Obviously, right now is only a Wednesday, so we could technically still move up. But right now we have 4 consecutive down weeks. Pretty good volume. First we had support from the 21 several times. That was taken out 2 weeks ago. Then the 50 came into play this last week, and then this week, and that's been taken out. So one by one, key levels are taken out. One by one, moving averages are taken out. The S&P could turn at any point here, but the further it goes down, the longer it stays down here, the more solidified these upside price levels become. So if you were to trend line here, somewhere over here, like any type of bounce here, if we tried to bounce, that's going to be really stiff resistance. So to me, the uptrend is over, the chart is broken. And even in good times, it will take some time for the chart to repair. The only asterisk is if somehow the trade war stuff just completely cleans up and disappears, then the market can go straight up. But absent that, the chart's broken, and it's going to take some time to fix it. Here's the NASDAQ chart, similar but slightly worse off. Gap down this week. So it's got its entire body below the 50. The 50 provided resistance or support there. 50 support there. The 20 was kind of support in here a little bit there. So first it took out the 21. Last week it took out the 50, but then moved above it. Now it's below the 50 again. If we get any type of bounces, there are several levels up here, both in terms of price movement and in terms of moving averages, that are going to resist the upside progress. Okay, so again, to me, the chart here is broken. It's going to take some time to fix, and I don't think it'll be a quick fix unless we get some really good news. Okay, zooming in a little bit. Here's the S&P daily chart. You can see that for 4 months or so there, it channeled up, higher highs, higher lows. The higher highs weren't, they didn't run away and get any distance between themselves and the previous high, but they made higher highs, and then obviously it just completely broke down. First a support level in here, then some moving averages, then it just went down, 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 down. We haven't had 2 consecutive up days in over a month, about a month. So lots of levels above. Even if the market tried to bounce here, you got the 200-day moving average, which has been taken out for the first time in a while. You got the 21 over here. You got the 50 way over here. You got potential support turning into resistance over here. So even if we get a healthy bounce here, it's going to take some time. Psychologically, the market's broken, and it's just going to take some time for the charts to heal. So best case scenario is we chop around going sideways. Worst case is we keep heading south. There'll be a bounce in there somewhere, but it'll probably get sold into, and we'll head south from there. Again, to me, the only real fix for the market is if all this tariff news was taken off the table. But as long as that stays the case, I don't see a quick fix here. NASDAQ, same thing. Okay, when the S&P was making a new high over here, the NASDAQ did not make a new high. It's a little bit of a warning. Then you can see we just went straight down, just down, down, down. Haven't had consecutive up days since back here. To me, the chart's broken. You got 200 support here. Now the 200 can be resistance here. All these moving averages have rolled over and are now leaning down. So it's going to take some time to fix this. It's not going to be a quick fix. All right, let's get into some breadth reading. So here's the 10, 20, and 50-day moving averages of the NYSE AD line. Okay, you can see over the last 6-7 weeks, decliners have steadily beaten advancers when looking back 10 days. Decliners have also outnumbered advancers when looking back 20 days. There were divergences in there that, told us something was wrong. We had a higher high over here, and yet, lower high there, lower high there. So there were a little bit of warnings. The 50 is still in okay shape. I guess, there were some negative readings that came off the calculation, so that as the market was falling over here, we were still able to move up. But those negative readings have now fallen off the calculation. So now the 50 is down below zero. Never able to make any headway. Even when we're up here or at the new highs, the 50-day moving average of the AD line was negative. So definitely like a lack of participation on that last push up. It was definitely a warning. It happens. You got to listen to it. Next up is the cumulative AD line. So we're going to just like every day, advancers minus decliners. That's going to be a number. It could be positive. It could be negative. We're just going to add it. We're going to add it up. And you can see what happened here is as the market was moving up, high. Whoa, I don't want that. Higher high over here, another higher high over here. We had, lower high. So not a big deal. I mean, for this to move up and just consolidate here was not a warning, even though we made a new high and this didn't make a new high. But as you can see, we've fallen down here. The 21 is now going to be resistance. We got some distance here between the AD line and the 21. So even if we get some improvement for a couple of days and the AD line starts to move up, we have some resistance above. It's going to take some time. To me, like best case would be something like this where it like chops around for a month before it can move higher. Worst case is we're just not done falling. We got to go down further. All right, let's get into a few others. This is the 5-day lows reading, okay? So this is like a little sliver of light that as the market fell, over here, it's the S&P 500 up top, the 5-day lows down below. As the market fell here, less stocks printed new lows. Okay? So market fell hard here. We got 3,700 stocks making new lows. Market fell hard again yesterday, and now we only have 2,300 new lows. Okay? So less stocks printed a 5-day new low, so they resisted falling. It's a little sliver of light that the market is less bad in the short term, so not too bad. We get the same print with 1 month new lows. We got lower lows here, but less stocks fell to new lows. That's good. It's good if you're bullish and you want the market to bounce. And here we have 3-month new lows. Same thing. Okay, market fell to a lower low, and then less stocks participated. So it's a little bit less bad. It's not great, but it's less bad. And then here is the large cap, small cap, mid cap, and small cap 52-week lows. And you can see as the market, we got spikes over here in earlier March, and then as the market continued down, we have less stocks, 52-week lows, less mid cap stocks, 52-week lows, less small cap stocks, 52-week lows. So with the high-low data, well, this is actually just the low data. For the number of stocks falling to new lows, there's like a little bit of a sliver of light saying that less stocks fell. Many of them held up and resisted falling. All right, now we got more negative readings. This is Russell 3000 stocks above their 5-day moving average. Basically, as the market dropped here, we pretty much had the same number of stocks down. Okay, it's not bad. Okay, typically in a bad downtrend, you get prints way down here in single digits. So it's holding up. Not everything is getting crushed. So what that tells me is when only 20% of stocks are above their 5-day moving average, is the market's falling. A lot of stocks are falling. A lot of stocks are losing this moving average. But there's some safe havens in some places, whether it's REITs or there's definitely some ADRs because Europe's doing really well right now. So some stocks are holding up. So we haven't had a complete washout where everything gets clobbered. And here, but you back up a little bit, stocks above their 20-day moving average just continues to go down. No green shoots there. And then here's Russell 3000 stocks above their 50-day moving average. So again, down, down, down. Now it's at like 20%. All right, so to me, the indexes are broken. Okay, this is not a pullback within an uptrend. A lot of damage has been done. It's going to take some time for them to fix. Little bit of hint that the market is less bad in the very near term when you have less stocks falling to 5-day and 1 month and 3 month lows, but everything else is just pointing down, trending down. So even if we get a bounce, I don't see the bounce lasting overly long unless, again, we take tariffs off the table. Okay, to me, technically the market's broken. Psychologically, the market definitely is broken. If the market bounces, a lot of people are going to use the bounce as an opportunity to get out. And best case scenario I see right now is just move sideways, chop around in a range. Worst case is we're in the beginning stages of a downtrend and we're down 10% and we don't know how far it's going to go or how long it's going to last. So you definitely want to be careful out there. All right, we'll see you next time. Hopefully you got something out of this.